Welcome to The Explainer. Today, we're putting on our expert analyst hats to ruthlessly interrogate the financials of a true giant, Archer-Daniels-Midland, better known as ADM. We aren't just looking at standard metrics today. Oh no. We are putting this stock through the ultimate stress test, using the legendary investing frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, and wrapping it all up with modern discounted cash flow modeling.
Here is our roadmap. We'll grab a quick company snapshot, pass ADM through the lenses of three investing legends, run a strict DCF model, and then synthesize the whole shebang into one final verdict. Let's get to it.
Section 1. ADM Company Snapshot. We're starting with the baseline facts for Archer-Daniels-Midland, a massive global operation processing grains and oilseeds into food, beverages, and animal feed.
To set the stage, ADM is currently trading at around $80 a share, sitting on a substantial market cap of $38.7 billion. But check this out. The trailing PE ratio is 37.1, based on an earnings per share of $2.25. For an agricultural processor, that multiple is definitely on the higher end, which gives us a fantastic starting point for our valuation tests. But you've got to respect their immense pedigree in the market. ADM boasts 53 consecutive years of dividend growth. 53 years! They actually just bumped their quarterly payout by 2% to 52 cents a share, leaving them with a solid 2.6% yield. This kind of relentless cash return history is exactly what attracts value investors in the first place.
Let's move to our first expert framework. Section 2, the Warren Buffett lens. Time to see if ADM possesses the durable economic moat and consistent earnings that the Oracle of Omaha absolutely demands.
So running through Buffett's classic checklist, ADM definitely has a strong moat as a key player in the global ag processing oligopoly. Manageable debt? Yep, backed by a solid Fitch A rating. Management is also executing an aggressive $500 to $750 million cost-saving initiative, signaling great capital discipline. But it's not a perfect score. Earnings consistency is a bit mixed because crush margins are highly cyclical. And more importantly, its adjusted return on invested capital sits at just 6.4%. That frankly falls quite a bit short of Buffett's high return standards.
Now let's calculate Buffett's absolute favorite metric, owner earnings. If we take ADM's whopping $5.5 billion in full-year operating cash flow and subtract an estimated $1.4 billion in capital expenditures, it leaves us with a really robust $4.1 billion in owner earnings. Now, if we apply a conservative 10x multiple to that cash flow and demand Buffett's signature 30% margin of safety, we arrive at a target buy price of roughly $59.78. So for Warren, today's $80 price tag is just a bit too rich.
Moving right along to Section 3, the Peter Lynch lens. Lynch's whole philosophy is about categorizing the company correctly first and then evaluating its growth metrics against its current valuation.
Lynch would take one look at ADM and instantly label it a cyclical. Their fortunes are completely tied to crop cycles, export volumes, and those notoriously unpredictable biofuel policies. Because it's a cyclical, that trailing PE of 37.1 is pretty bloated, giving us a really unfavorable PEG ratio right now. The only way that PEG normalizes is if ADM's forward 2026 earnings hit the absolute top end of their recent guidance.
Let's run through Lynch's additional checks. Strong balance sheet? Yes, absolutely, with $31.5 billion in adjusted invested capital. Now, because specific insider trading data is missing from our sources today, we're going to play it transparent and assume neutral insider activity. Furthermore, as a major S&P 500 staple, it definitely lacks that low institutional ownership Lynch loved to find in hidden gems. Put it all together, and the Lynch-style verdict is a clear hold until this cyclical downswing in crush margins fully bottoms out. Let's transition to the grandfather of value investing. Section 4, the Benjamin Graham lens. We're going to see exactly how ADM stacks up against Graham's notoriously strict defensive investor checklist. Looking at the checklist, ADM crushes the first few tests. Adequate size? Pass. Strong financial condition? Pass. Earning stability and that incredible 53-year dividend record? Pass and pass. But Graham is absolutely ruthless on price. The current PE of 37.1 completely shatters his limit of 15. And the price-to-book ratio of 1.8? That breaks his strict 1.5 ceiling. For a Graham defensive investor, ADM flat-out fails the valuation criteria at current market levels.
To get a hard numerical baseline, we apply Graham's famous intrinsic value formula. We take the square root of 22.5, multiplied by the trailing EPS of $2.25, and multiply that by an estimated book value per share of $47.50. This brilliant formula strips away all the market noise and focuses purely on earnings and tangible, hard assets.
The math gives us a Graham intrinsic value of $49.03. But remember, Graham never paid full intrinsic value. A true defensive investor following his framework demands a 33% margin of safety. That means they'd sit completely on their hands waiting for a target price of around $32.68 before even thinking about initiating a buy. We are miles away from that today.
Moving from the historical legends to modern methodology, we hit Section 5, DCF and other models. Let's see if modern Wall Street math is a bit more forgiving to ADM than the classic value investors were.
To build our DCF, we're projecting forward using that $4.1 billion owner earnings base we calculated earlier. We apply a very transparent 7% weighted average cost of capital, which makes total sense given their A credit rating and manageable debt. And we use a conservative 2% terminal growth rate to mirror long-term GDP growth. Now look at this sensitivity table. It's fascinating. In our base case scenario right in the middle, a 7% WACC and 2% terminal growth, we get a fair value of $82 per share. With ADM currently trading right around $80, modern DCF modeling is basically telling us the stock is priced perfectly at fair value today, assuming management's cash flow projections hold steady.
Checking this against some alternative models gives us great perspective. The dividend discount model prices ADM super conservatively. It's just $42.43. Why so low? Because historically, their dividend growth rate is pretty modest, hovering around 2%. Meanwhile, a quick comparable analysis shows ADM trades at a significant premium to its main rival, Bunge. Bunge's posting an EPS of $4.33 next to ADM's $2.25. The market is clearly demanding you pay a premium for ADM's specific asset mix and dividend safety.
We've gathered all our evidence. It's time for Section 6, Synthesis and Final Verdict. Let's blend these highly conflicting signals into one definitive investment takeaway.
When we look at it all together, there's a really stark contrast. Modern DCF modeling says ADM is fairly valued right now at $82. But literally every single classic value framework, Buffett at roughly $60, Graham at $49, and the DDM at $42, screams that this stock is just too expensive right now to provide a proper margin of safety.
As an investor, you have to weigh these opposing realities. On one hand, you've got an absolute cash generation engine with strong ethanol margins and a legendary 53-year dividend streak. But on the other hand, you're battling some serious near-term risks. We're talking a high trailing PE, wildly cyclical crush margins, crop quality issues in the EMEA region, and major regulatory uncertainty around U.S. biofuel policies that's keeping fuel demand in limbo.
Which brings us to our final expert analyst verdict. ADM is a solid hold at $80. If you want to satisfy the rigorous criteria of legends like Buffett, you really need to wait for a cyclical pullback into the $50 to $60 range. So I'll leave you with this to ponder. Do you trust the modern DCF valuation that says ADM is fairly priced today? Or are the classic value gurus absolutely right to demand a much wider margin of safety before buying into a cyclical giant? Thanks for joining me on this explainer, and keep interrogating those financials.